Most wealth advisors won't talk about real estate. Nick Pavia will, because he's owned it, screwed up, and figured out what actually works. This is GRID Charleston, a monthly investor meetup right here in Charleston, South Carolina. Every month, we bring in someone who's actually in the market doing the work, and we talk about what's working, what isn't, and what real numbers look like. No gurus, no selling from the stage, just real conversations with people who've done the work. GRID is part of a global network of over 30,000 investors across 30 plus cities. I'm Paul Kelton, a multifamily real estate broker here in Charleston, and I'm also an operator. I started GRID because I wanted a room where investors could get real information from real operators, and that's exactly what we built. Before we get into it, huge thanks to our sponsors, Tide Property Management Co., Coastal Equity Group, Matt O'Neill Real Estate, Sweetgrass Capital, Coastal Creative Media, Mitchum Law Firm, and Apollon Wealth. We couldn't do this without them. If you haven't connected with them yet, please do. They're not just sponsors, they're part of this community, and they're our partners. Now, Nick Pavia is a wealth advisor at Apollon Wealth. And unlike most people in his seat, he actually owns real estate. He's done fix and flips, buy and holds, and has made expensive mistakes along the way. So this conversation isn't a service level pitch for real estate. It's a frank breakdown of how it fits inside your serious financial picture, what you need to have in place before you buy, how you structure your LLCs as you scale, when leverage is smart and when it's dangerous, and why owning real estate inside an IRA is a lot more complicated than the podcast make it sound. Here's the conversation. Yeah, Nick Pavia here. Thanks for joining us, Nick.
Thank you, bro.
So Nick is a wealth advisor. I'm going to let him do an intro, and we're just going to talk about how real estate should fit into your overall investment portfolio, the different ways to do that, and how you should be prepared this evening.
Yeah, I appreciate it. Yeah, my name is Nick Pavia. Firm is Apollon Wealth, and Gavin Dooley and I work on the same team there, along with our relationship manager, Caroline Clark. I'd say that we're a little bit unique in our space in that we are very pro real estate, meaning a lot of times you'll go talk to a wealth manager and you may say, hey, I want to buy this rental, and say, hey, don't take the money out of the brokerage account because I want to get my point on that, right? Or whatever. The way I look at it is rising tide lifts all ships, right? And so the more successful we can help our clients become in whatever capacity of interest is of them, the better, right? One day you're going to be happy with us if we help you get a real estate deal done, and you're going to tell your brother or your sister or whatever. And that's how our business spreads, right? Not just doing things like this, but of course, happy clients, right? Tell their friends. And so what I try to do when it comes to real estate investing is, number one, help educate clients on different options. I'm an investor myself. I've done the fix and flip. I've done the buy and hold. I've owned multiple properties. I've gotten burned, to be completely honest, right? I've made some good deals too, right? Kind of working through some experience, so I can kind of paint a picture of certain different instances that you might be going through and thinking about when it comes to real estate investing and really building your net worth to get that next deal done, right? That's what it's all about. So happy to be visiting with you all today and happy to field any questions you guys might
Thanks for
have.
being here. So I guess tell us, because this is a real estate investing group,
Right.
so you have experience real estate investing.
Yep.
So kind of tell us about your journey from when you started to where you are now.
Yeah. So when I came out of college, it was 2005, right? And the real estate market was red hot, really hot here in Charleston. I saw my friends buying real estate and I was like, man, I'm missing out, right? And those were the days of no doc loans. So my buddy, who's still a really good friend of mine, was in the mortgage business at the time. He said, Nick, no problem. We can get this loan done for you. I just come out of college. I was working in the insurance business then, not really wealth management or running money, but in the insurance business then. And he said, hey, Nick, you just graduated. How much money do you think you're going to make this year? And I said, I'm going to make $100,000. Like, of course I am. This is going to be easy. And so I bought a little condo for $140,000, right? And right over on Ben Sawyer. It was one of those classic deals where the guy had, it was rentals and then he condoed them and like was going on all over town. And then, then the market kind of took a nosedive. Everybody thought real estate was supposed to go up in a straight line, but it doesn't always, right? And so kind of went like this. And all of a sudden I was looking at a $140,000 investment, not making exactly my $100,000 yet. And I said to myself, boy, this wasn't the greatest thing. Now I was able to hold on and wait for it to recover, but it was a tough ride for a time, right? And, I went into it thinking, oh, this is going to be easy. I put basically no money down. And so I had no cushion in that deal, right? From an equity standpoint. But what I learned was that, okay, in order to be a sound real estate investor, you need to have your financial house in order first. And it's okay to wait a little while to kind of build, right, your net worth, build, your net worth over time to get ready for that first, second, third, fourth deal. Make sure, God forbid, something does go south, you got a contingency plan in place, right? And so I almost got burned on that first deal. I was able to ride it out, but I learned so much through that, right? And that really built the way I look at real estate kind of going forward.
Yeah, awesome. So you kind of mentioned it. What should people have financially in place before they buy the first investment property?
Yeah. And so, what I always tell clients to say, hey, look, right, if it's the first investment property that you're looking at, chances are we got to come up with 20 to 30% down. Right. So the question is, where is that money going to come from? Do you have a rich uncle that's going to give it to you? Maybe, maybe not. I don't have one. I'm still looking for him. He hadn't come around yet. So like at the end of the day, like that wasn't something I had. So I had to kind of save. I had to maybe rob Peter to pay Paul to come with that 20 to 30% down. If I'm talking to a client, that's the first thing I ask them. I say, if you own your primary residence, right, you can get away with putting a little bit less down depending on your profession, right, and not get absolutely crushed based on rate and PMI and all the rest. But in that second property, we got to get 20 to 30, right? Where's the money come from? And how are we going to build towards getting you there? And then how are we going to clean everything up from a credit score standpoint and everything else so that way you can close on that second property? Right.
Yeah.
We do go into talking about the different ways in which you can finance, right? I don't know if we're going to talk about that in a little while, but basically what we try to do is say, hey, let's make your picture look as clean as possible to qualify for that next loan.
So what does a clean financial picture look like?
Yeah. So I mean, I hate to bring it up, but and I don't like worshiping at the altar of the FICO score, but at the end of the day, like you have to have a good credit score to a certain extent, right? Understanding your credit score, the algorithms they use to. I mean, I've had a situation where I paid off a car and my credit score dropped the next month for like a couple months, which seems ridiculous, right? But you have to understand, hey, what goes into your credit score, right? So first thing, obviously, you need a strong credit score, right? So work towards that, number one. Second, you need to have reserves, right? And it doesn't even necessarily be cash. It could be brokerage account, could hypothetically be a retirement account, although that's the best place to go to cash because of penalties and everything else. It could be cash value in your life insurance program if that turns you on. It could be an annuity. It could be a lot of different things, right? But where do we have reserves on top of that 20% down? Gosh forbid something goes wrong, you can't find a renter, something breaks, you need to fix something, right? What I always say is you need an emergency fund for your household, 3 to 6 months of expenses. You need an emergency fund for your business and your rental properties and your
So
investment properties.
what would the, like, I guess, percentages wise, like how much are we talking with your total portfolio? Like you have real estate over here, you have liquid, like some sort of liquid
Mhm.
investments here, you have your brokerage accounts here. When you're advising your clients, what are you saying? How much should you allocate for each
It,
area?
it, I would say it would depend, right? So everybody kind of builds wealth, right? Whether it be through real estate, whether it be working just their W-2 and putting money into 401k. Obviously, in this group, you guys are talking about real estate investments. What I would tell a client is you need at least 3 months of rent payments somewhere in the bank, probably 6 months, right? Of liquidity. God forbid that place goes unrented for 3 to 6 months, right? I've had situations where I thought for sure it was going to be this place was going to rent like that. Well, it just took me a couple of months to either get it ready or to do this or do that, or I had to hang up somewhere. And so you need some liquidity in the bank or have a W-2 job outside of it where you have really strong income from another source, right? And your living expenses are low enough to where you can build that margin in, right?
Mhm.
To cover the note payment along the way.
Yeah. Yeah. So what do you typically, you mentioned you separate out the personal emergency from
Right.
the rental property,
Mhm.
right?
Typically, yeah.
Okay.
Yeah.
So what, I guess I just want to get a little bit more granular on it.
Yeah.
So when you're talking about like the ideal investment portfolio or the financial picture for someone
Yeah.
to be buying real estate,
Yeah.
what do they need on the back
Yeah.
end to do it really,
Yeah.
really
So
well?
to do it really well and do it safely,
Yeah.
right? So what I like to do is kind of think about it in sort of two different silos almost, right? You're the master of your domain, but you have your personal sort of planning, right? And your personal emergency fund, et cetera. 3 to 6 months, we all know that. If not, it's 3 to 6 months, right? Personally in cash. So that way, if you're out of work or sick or whatever, you can pay your bills for a time. And then when it comes to your real estate portfolio, kind of looking at it a little bit separately, that's a business unto itself, is the way you should think about it, right? You have an LLC that owns the real estate. LLC has a checking account all the rents go into the LLC checking account. It doesn't come to you, right? You have a separation of church and state. God forbid something goes wrong there, trip and fall and get sued, whatever it might be. But inside of that LLC checking account, I like to see about 6 months at least of cash reserves for you to pay the note. God forbid, you have a water leak and it takes time to fix it, right? Now, when it's your first sort of rental property, there's going to be some bleed over, right? There's going to be some, I'm going to take some money out of here to take care of that. But as you expand your portfolio up to, you have one, right, rental, you say, well, I like this or I don't, right? You get to 2 or 3. Do I like this or I don't? Do I want to? Once you get to 4 or 5, you say to yourself, okay, am I going to scale this and I'm going to go to 10, 15, 20, or am I going to stay small and kind of take care of everything on my own, right? So those are 2 different sort of strategies, I would say. If you're in like that 2 to 3 rentals or 2 to 3 doors to 5 doors arena, I like to see, you kind of look at it and you add up your monthly note payments. Say maybe I have 3 to 6 months of note payments sitting in cash is a good sort of barometer, plus or minus, typically in that LLC checking account. Because there's going to be a time where one of those rentals, something happens and you don't rent it for a time, right? And you want those reserves. Now, I'll tell you, the more doors you have, your risk goes down. Right. Because if you think about it, if you have enough rent, say you have 20 doors that you're renting. Well, if one goes empty for a couple months, you have enough rents coming from the other pouring into that LLC checking account, right? To kind of, stem the tide per se. And anytime you have someone, the folks from Tide will tell us, anytime you have someone move out that's been in a rental for 2 or 3 years, there's going to be a couple of months of maybe painting and replacing carpets. There's going to be a couple of months kind of fixing the place up, getting it right for the next renter. So you get max rent out of it, right? And so it doesn't happen like this. I mean, what's the typical term time for one of your rentals? Okay, well, I'm lying then. So if he can do it in 2 weeks, then I need to hire this guy for the next until I buy. So that's great. It's always taken me like way longer. I feel like it's always taken me like 4 weeks to get it relisted, maybe 6, because I'm fixing some things, right? And then kind of ripping out carpets and painting, et cetera. Great question. So it depends on the state you're living in, number one, and the state that your rentals are in. Are rentals all in this example, all in South Carolina?
I don't have anything.
Okay. Not yet. Okay. It depends on what states the rentals are in. Let's say South Carolina. And we got what, 5 to 10 in this example, or
Let's try
2. So I think with just two doors, I think you're okay doing maybe one LLC, right? But when you talk to attorneys, what can happen is if you have one LLC owning 2 doors and you have significant equity and value in each one of those, when I say doors, each one of the rentals, if that makes sense, okay? And then say so you have a slip and fall in rental A, well, you get sued and they come off the value in rental B. So as you get more rentals, and it's actually easier than it sounds, what a lot of attorneys will tell you to do is say you get up to 5, you may have LLC 1, 2, 3, 4, 5 individually, but they all roll up to a master holding company. So you have one master holding company that all the rents and everything rolls up to, but it helps to insulate each one of the individual rentals. And so if you talk to someone who's got like, say, 20 rentals and they've done that type of creditor protection work, their LLCs will be like the name, the address of each one of the rentals, right? To kind of keep it straight in their minds, typically. And that way it doesn't have your own name in it. And then it rolls up to a master holding company. And the master holding company is the one they're actually managing on the day to day. Does that make sense? Yeah, of course.
So, from your seat as a wealth manager, why does real estate belong in a serious investment portfolio?
Well, I'd say it doesn't always, right? So there has to be a comfort level with it. And we're talking about owning real estate directly, right? In this example, right? So like you're running and so I would say, there is a fascination in many cases. My friend is making so much money in real estate. Like I want to do that, right? And so you really need to do some education on the front end, whether it be listening to, different podcasts or whatever it might be. But I love it personally because it's one of the true assets where it's easy to get leverage for it, right? If I take a loan out on a stock portfolio and the stock market drops, 20, 30, 40%, I got a margin call I got to deal with. I got to come with cash right now. If we go through another 2008, right, and you have a bunch of rentals with maybe you put 20% down in, and the values, right, drop below your loan value as an example, as long as you have certain types of loans, right, the loan's not getting called. You can ride it out as long as you have the rents to pay the loans and let it come back. So for me, it's the safest way to leverage yourself, right, to gain wealth, right? Even if the real estate market over the next year does say 10% return, and the S&P 500 does, 12%. If I'm able to leverage myself, my cash on cash returns are much higher over that time period if you feel comfortable using leverage. Now, if you're sort of maybe at the end of your career and you've paid down a lot of your rentals, and right, they're just cash cows, right? They're just pumping out rents and you're not having to service the debt. So it's a great way to provide steady income in lieu of a pension or in lieu of, maybe a small social security payout or whatever it might be,
Yeah.
um, for me,
So, do you feel like that there's any ways, and like, because there's a lot of media out there about real estate right now, right? A lot of content out there. Some of it I feel like gets oversold, and some of it might be in reality of what we've seen in the
Right.
past couple of years. But I guess, where do you feel like real estate gets oversold, or what type of
Yeah. So like, when I was learning about real estate, I used to go to BiggerPockets conventions. Have you guys ever heard of BiggerPockets and the podcasts and all the books and all the things, right? Kind of dawned on me as I tried to do a couple of BRRRR deals where you buy something and then you fix it up and the property value goes way up and then you take your money out and then you rent it. The way it was described to me in some of those books from BiggerPockets, it was much easier than what I experienced personally. And so I'm like, am I that dumb? Like, I don't know. I'm not that sharpest knife in the drawer. Don't kid yourself. But like, I'm like, so I feel like, are these guys doing this to sell the next book type of thing, right? Or are they actually giving really good advice? And so I think it's probably somewhere in between.
Yeah.
In some of those podcasts, I think a lot of the strategies can work in certain markets, but it's not universal. Charleston's very unique. We have very high property values here, and I don't know that the rent always substantiates that in certain cases, especially downtown, right? And so it all depends on what your strategy is, right? Your appetite for fixing places up, for doing renovations. Have you ever done a renovation, right? Like,
Yeah.
I think a lot of people over renovate,
Oh
spend too
yeah,
much
for sure.
money and then like, they can't get the money out. And so, you know, there's a lot of different things you got to be mindful of, I think, when you think about this.
What client type or investor type or personality do you think should not own real estate?
I think if you are the type of person that worries about, if you have, like, say, for instance, you have a 401k at work, right? And you have maybe 50, 100 grand, whatever the numbers in it, and you look at it all the time and you stress about the markets and you turn on the news and you worry about this and you worry about that. And your temperament is one to where, like, things around money or finances really upset you and you stay up at night. Or, it's okay to stay up some nights worrying about things, but if you're up night after night after night stressing, then maybe not for you. I don't
Yeah.
know. The other thing is, if you're buying properties and you hold them near and dear to your heart, renters are renters. I was a renter in college. They never renewed our lease after the year, because yeah, it was a different time in my life, right? And so, like, at the end of the day, like, college kids are college kids, right? You got 5 college boys living in your house. Guess what? You're going to have some things to fix, most likely when they move out, right? And if that upsets you, right, and that's not part of your game plan, and not knowing that, you can set yourself up to, some real heartache and some, sleepless nights. I think it's the person who typically, right, doesn't get upset by that, doesn't take it personally, right? It is what it is. Once again, rental real estate is a business unto itself. Right? And so that's why you kind of have to approach it.
Yeah. So you mentioned leverage a couple of times,
Right.
leveraging to get real
Right.
estate and how it's different from other type of investments. Where is a smart level to leverage? What's like teetering on the edge of like starting to get dangerous?
Yeah, I think if you follow the rule on your second, third, fourth, fifth property of trying your best, and it doesn't always work out, to do that 20 to 30% down, so that way you have that margin
Mhm.
in case we go through a recession, right? Is a good sort of, there's a reason why banks for traditional type loans want the 20 to 30% down for second properties, right? It
Right.
protects you, it protects them, right? Now, if you're going to do, and I know the hard money guy in the back is kind of leaning back like this. He's like, no, we can do, he's like, the hard money's like, oh, he's like, I got money for days. I can, 5%. No. And listen, but when I've got, no, but when we're talking about, see, you already rolled up several pieces of real estate, right? And they're well capitalized and you have cushion, right? When I say cushion, there's equity in them, right? And you have some wiggle room there. And you have your eyeball on maybe your fifth, sixth, seventh rental, and the regular traditional lending is not an option because your debt to income ratio is not there or whatever, right? Well, then what we do is we call the hard money guys in, right? And you've already been seasoned, right? You got 4 or 5 doors, you got a couple things going out there. You're used to running a rent roll. You kind of get it, right? You see opportunities differently than you saw them a couple years ago. right? Then I would say, okay, well, we're well capitalized over here. We got cash in the bank, right? Maybe you are tilted heavier if we looked at a pie chart of your net worth towards real estate, which I'm okay with because that's what we feel comfortable with. We have reserves elsewhere. Then maybe we do on that next deal, we say, all right, well, we'll do 5-10% down using hard money. They'll give you some money to fix it up maybe. And then you get some renters in there, refinance it, and then kind of restructure that loan package once you have a rent roll. And that's the way I've seen a lot of guys kind of build over time, and gals, because you get to a certain point where because of liquidity, you can't expand, you can't go to the next level. So you have to get creative.
Yeah. What do you say to the people like who are like, I want to buy my first rental. I want to do it like this year. And they might not be like the most well capitalized person. They don't have as much capital there in the bank to do it.
Right.
What do you say to those people if they want to like jump in and start investing in real estate?
Yeah, I would say, maybe start small. Maybe Charleston's not your market. Maybe you need to go to Moncks Corner. Maybe you need to go to Columbia. Maybe you need to go to Birmingham, unfortunately, right? You need to go somewhere where you can get, not unfortunately, Birmingham's a great market. And I mean it that way, but I mean from a distance having to travel to see it type of thing. But you get someone like Tide to manage it, right? Then you're okay.
Yeah.
But you can get into some other markets. You can get a 3-2, or you can get maybe if you're into college housing, you go to some of these other markets, you get in a lower price point than you get in here. I mean, you look at what the prices are going for downtown. I mean, like for a lot of people, that's price prohibitive.
Sure.
At any level.
Yeah.
Right.
So I want to talk about just for a second. So I've heard about self-directed IRAs.
Yeah.
And I've had some clients bring it up to me before. They have all this money. The idea, I believe, is like you have all this money sitting in your retirement account, put it to work in real estate. I know it's a really popular thing with podcasts and books and stuff. So have you dealt with that? Do you know kind of strategy?
I've get asked that. Probably get that question like once every 6 months about. And what we're talking about here is, say you have a $500,000 IRA sitting out there, or rollover something or other, right? And you really like rental real estate and hands-on rental real estate, right? You own it directly. There are some challenges around putting a property inside of an IRA. Now, there are custodians that do it, right? That oversee it for you. But the IRS has a whole separate set of rules by owning a hard asset inside of an IRA. Now, what's a hard asset? It could be real estate. It could be precious metals, right? It could be collector cars. It could be wine. It could be art. It could be a lot of different things. But these things are not, they're not marked to market every day, right? The market closes and we know the value of your stock portfolio every market day, right? And so if you need to liquidate it because you're coming up on age 72 for your RMD, right? And you take 3 points, it's easy to do. It can be executed like that. If it's in a hard asset, how do you sell 4% to meet your RMD, as an example, required minimum distribution, right? And there's mandates you take the money out. If it's in a beach house, how do you sell 4% of a beach house, right?
Yeah.
You can't. And so the IRS has all these rules and mandates about having hard assets. Now, can it be done? Absolutely. Now, here's the other thing that's interesting is that there's a bunch of interesting rules about how you take care of the property, meaning you can't do any of the work. You can't spend any of your personal money. So say you buy a beach house inside of your IRA, right? You can never spend one night there. Your kids can never use it, right? You cannot use any of your personal money to take care of it. It has to come out of the IRA. And there's a bunch of clawback rules. So it's extraordinarily difficult to execute. While it can be done, it's difficult, right? Now, here's the other problem that I see with it. And the reason why I haven't done it is because there's some really cool tax advantages from owning real estate outside of an IRA, right?
Yeah.
Depreciation, all the other cool things we can do, right? And you lose all those, right? Why not do it the easy way? Put assets that are marked to market every day inside of your IRA that are liquid, that you can sell, get in and out of, right? If you want real estate in your IRA, fine. Use a REIT, use a private placement. There's lots of cool creative things, right? That you own shares of, right? That are marked to market and you can get out of. You want your investment in your IRA or Roth to be marked to market at least once a month. Real estate, beach houses, you can look on Zillow, but until someone buys it from you, that's not marked to market officially by the SEC, right?
Yeah.
And so it can be very difficult.
Yeah.
Does that make sense?
Yeah,
I know we're getting a little
super
technical,
helpful.
but also difficult.
Yeah.
Right. And so we're talking about the same thing. That's a great question. So, not when we're talking about lending, we're not talking about owning a bond. We're not talking about, some other lending structures. We're not talking about private credit, right? We're talking about things where you're actually orchestrating loans. A lot of people in the community, and I don't want to say like old guys, but that's truthfully who it is. It's like people have made money and they say, hey, I want to change up my investment profile, will lend money, right? Most of the private hard money guys in town, you guys have getting money from other people, right? And then you lend, you charge a point or two, or wherever the spreads are nowadays. But when you're getting money out of an IRA, all those same rules apply, right? If you need to unwind it or you need to move the IRA and take your distribution out, how are you going to get that loan out of it like that? And that's the problem with the IRS has, the illiquidity of some of these hard assets or hard loans. We're talking about lending money or owning a hard asset inside of an IRA. Yes, ma'am. A REIT? No, REIT's fine because a REIT, a real estate investment trust, you own fractional shares of, and it's marked to market daily. Yeah, absolutely. So there are lending programs and there are real estate programs that are 100% blessed by the IRS to be put inside of an IRA. And we do it all the time, right? I just the other day put like 20% of my IRA in a real estate program, right? But that thing, I own shares of it and I'm monthly liquid in it. So the IRS is okay with it, Yes, of course. Yes, ma'am. And I may be wrong about all this. So you're the CPA in the room, so you tell.
It's great for real estate. And finally,
When I did some additional, I'll be honest, I did some additional studying preparing for today because I had a feeling with the real estate group I was going to get that question, and I had to remind myself, and so I was going back through old notes, and I was like, oh yeah, about it was very interesting about if you own a piece of real estate, like, and you need to fix it up or service it or whatever. The other thing is, if you have a mortgage inside of that IRA with a piece of real estate, it gets really clumsy to run, right? And what if you have enough money in your IRA to service the mortgage because it went unrented for 6 months or so? You know what I mean? There's so many things that could go wrong with that strategy. It makes me extraordinarily nervous. Not to say you shouldn't do it. I'm just saying it just makes me a little, I know the rules. Makes me nervous a little bit, just personally.
Well, this has been awesome.
Yeah.
I've learned a lot. What questions do we have in the room? I know we have some questions out here. What additional questions?
On the same subject there, you also can't put the assets in an LLC in an IRA, right? So,
There's no protection. That's another great. Thank you for reminding me of that. That's another great thing. You have thing to be mindful of. What about creditor protection?
right. So you could have a big buffer of liquid in there, but it would have to be in something like treasuries, something that doesn't go up and down,
Right.
too volatile, and that could take care of your distributions.
Right.
That's probably how people do it, but it still seems pretty klutzy.
I've had one experience where I got a phone call from someone trying to unwind one, but they had been using it personally like 1 week out of the summer. Like you can do it, normal rentals, you use it for 2 weeks out of the summer. That's the reason why people have, you know what I mean? Whatever, it's not renting. Let's go use a beach house. And it was something up in Isle of Palms, and he was having a terrible time because they had fallen in love with the asset. Right? His wife loved it, his kids loved it, they wanted to keep it, and he was screwed.
Sell it to themselves.
Trying to sell it to himself, and that doesn't work. You can't sell it to yourself. You can't sell it to your kids. That's go to a third party. Correct. You can't do that. So there you go. Yes, ma'am. If you're buying a REIT inside of your IRA or 401k or something of that nature, or Roth, no, correct. Oh, yeah, exactly. Yeah. So, whether it be a REIT or a mutual fund or exchange traded fund, basically what you're doing is you're buying shares of a pooled asset. And inside of a REIT, and there's different types of REITs. There's REITs that are daily liquid. There's real estate trusts that are like monthly or quarterly liquid. There's some that you have to stay in for 5 or 6 years, right? But the bottom line is you're diversifying, because typically inside of a real estate trust or some of these real estate, and there's real estate mutual funds, real estate ETFs out there, you're owning a share of thousands of different warehouses or whatever they're buying inside of that. There's tons of different types of those real estate type of investments out there. And so you're just buying a share of that, right? And yeah.
So if you wanted real estate exposure, why wouldn't you just buy a bunch of REITs and diversify versus going and buying a rental house?
So we're talking about now we're outside the IRA, right? So we want real estate exposure. If you put your money in a REIT, chances are it won't be leveraged. Now there are leveraged REITs as well, but you're never going to get the same pop if you own it directly. But if you own it directly, then guess what? You're responsible for fixing it up. You have to have someone like Tide to run it. That's 10%, a month of rent or whatever it is they charge. And so typically when you look at real estate investors, they fall into sort of a couple of different categories, right? You have the hands-on person who's like, that's their business. That's what they're doing. They have a ton of doors and they're like, they're fixing up. They're the boots on the ground, right? You have that sort of class of real estate investors, and then you have the person who has, you have the accidental real estate investor, right? Can't sell their house. They have one or two, right? Almost by accident. And then you have the person who's sort of like, I guess more like me, right? Where I have my day job, and this is something I do on the side, but I like to own them directly because then I can leverage it, et cetera. If that makes sense, right? And so there's different ways to own it, but there's plenty of people. I mean, if you came to me with $1 million rollover IRA and I built a portfolio for you, right? And you said, "Hey, Nick, drop what you would put your money in. 5% would be in 5 to 10% would be in real estate inside of that IRA, right? But on things that are daily liquid, so like REITs, et cetera, ETFs. Just like 5 to 10% would be in maybe precious metals if you like that, and then the rest would be in large cap, small cap, mid cap, et cetera."
Awesome. What other questions do we have for Nick? It's been awesome. Dude, Nick, yeah, I've learned so much. How can we support you as a community?
Well, number one, keep coming to these grid meetings. These are awesome. Thank you for having me. This has
Yeah.
been incredible. I can't wait to come to the next one and the deals and donuts and all. And, if you want to talk to Gavin or myself, we're all yours, right? This is one piece of what we talk about, it's important, but a lot of people in the community, I know a lot of advisors who don't even touch this. They don't even, it's out of their purview. I think that's not necessarily irresponsible. I mean, in Charleston, a big piece of most of my clients' portfolios, whether they like it or not, is in real estate. If they own a house here, that's a big piece of your pie. When you think about it, a lot of people their primary residence or a couple rentals, that's it. So it's important to understand it and what the impacts of it are long term. So I'd love to talk to anybody about it anytime.
Awesome. And you and Gavin are sticking around
Yeah.
for a little
Yeah,
bit.
that's okay. Yeah, I'd love
Awesome.
to.
Hey,
Yeah.
Nick, thanks so much.
Oh man, thank you for having me. Appreciate it.
All right. So we've got our next event for Tuesday of next month. We're going over the fundamentals of new construction. We're going to talk about, what you look for with land prices, how you estimate with construction. We've got a really great developer. He's building small multifamily spec houses all around town. So I'm super excited to bring him out. So please make sure you RSVP for that event. Thank you guys. Have a good evening.